log out of YouTube otherwise. Okay, good morning, everyone, and welcome to another episode of the Crypto Hour. Today is Friday, the 14th of June, 2024, and we've had quite a bit of news, economic news in the past few days. So let's go and dive straight into it, and then we'll have a deep dive in, how do we look if these numbers that they tell us are right or they're made up. So let me go and share. Sorry, not this. This we will look at later. Okay, so if we look at the calendar, so when we were here last week, we said that everybody was watching this number, the non-farm employment change, because the two things that we're looking at is inflation and the health of the job market. So this is the number that came in last week, much higher than expected. So it would be kind of like indicated that, there is a strong demand, strong job creation. So in a way, taking the emphasis away from the Fed from reducing interest rate. Okay, so it takes pressure off because of, let's say, the job market is doing well. So they say. So although the unemployment rate was ticking up, so that was the major news from last week. But also we had, this we already discussed last week, both the Canadian dollar and the euro that lowered interest rate by 0.25%. Okay, so this is kind of the start, kind of like as the major economies have like topped up in terms of interest rate and slowing down the economy when the inflation was really ramping up. Now they're more worried about making sure that the economy doesn't go into a recession. So they started lowering interest rates, and these are the first. The first one was Switzerland. A few months ago, and these are the next two. They're really now creating a small trend. So Canadian dollar, remember the euro, the UK is also expected to cut interest rates soon. But let's see what instead has happened this week. Okay, this week the main news that we were expecting were on Wednesday we had a GDP numbers from the UK. Especially now being in the middle of an election, these numbers are fairly important because Conservative Party was all like betting on, good numbers for the economy, which instead is showing to be pretty much like flatlining. So 0% growth and a very anemic 0.6, 0.7% growth on a yearly basis. So very, very, very slow growth. You could call it almost stagnation. The same on Wednesday, we had US inflation numbers. This being the CPI, so consumer price inflation, and it was actually lower than expected, which again, so there are like conflicting numbers for the Fed. From the same, from one hand, the job market is doing well. The other hand, inflation is going down. So there is less need to be, overly tightening because the inflation is going where they want it to go and trending towards the 2% target. So that was kind of like good for the stock market and everybody else that expects a lowering of interest rates. Now, obviously, then the same day at 7 p.m. we have the interest rate announcements that kept the interest rates at the same level, 5.5%, as you can see. So, but it doesn't really matter because this was as expected. But the indication of what the economy is telling us about where we're going next is more important than the actual numbers. Then on Thursday we had another measuring of inflation, which is now the producer price inflation. So at the entry level for when they're buying the prime material to produce their goods, and this again it's going down, or kind of like is even like lower than the previous month. So again, it's another pointer to, you know, no need to be overly tight. We can start loosening the reins a little bit of interest rates. So this is what pushes the market. Not so much the numbers that are causing any change in the markets, is kind of what the expectations are for the future. And then we had unemployment claims. So this is, again, we get, and we'll dive into this a little bit, you know, straight after this, but we'll dive into this in a minute. But if you see here, unemployment claims, so we looked on Friday last week that, you know, it looked like the job market was, you know, really booming and doing really well. Now we have unemployment claims, again, going up and higher than expected, and that has been the trend for a few, you know, for quite a few weeks. And if we look at slightly more detailed figures, so both the initial jobless claims, where people are asking for, you know, asking for unemployment insurance for the first time, it's going up, but also the continuing jobless claim now is like breached the 1.8 million. And again, higher than expected. So all the job indicators are indicating a deteriorating of the job market, right? And the announcement that we saw last week. Okay, so and interesting as well. So these are not things that will move the market, but I always look at what are the new prices for bonds of different duration, but also what are the prices for mortgages, because that's a little bit more, more important. Sorry, this is today, it's yesterday. So if we see here, we start very, very slowly now. Interest rates are starting to head in the other direction. So this is like very, very short term bond auction, you know, from 5.27 to 5.26. 8 weeks pretty much remain exactly the same. But if we can start seeing now, the mortgage rates are starting to tick down, 6.29 to 6.17 for the 15-year, 6.99 to 6.95 for the 30-year mortgage. You know, so this is what the market is pricing in basically, and we can see as well here a 30-year bond now. So the market is happy to you know, to accept lower interest rates for fixing their money for 30 years, from 4.63 that we had the previous rate, now it's 4.40. So it's quite a big difference, okay, for a long-term bond to happen in a small period of time. So this is why you know, it's important to take notice of these things. Now, if we go and look at, where do we start? If we see really, you know, when we look at unemployment is like the number of unemployed people, you know, and at the denominator, we have the size of the labor force. So now what we can see is that although the Native Americans employment, you know, the labor force it's barely growing at all. We can see there is a big influx of immigration. So people that come from abroad to work in the US, and it's something like I struggle to make my fellow UK citizens understand, you know, especially after, you know, all the discussions that were around for Brexit, is that the success of a country depends directly on how many workers they can attract to their country. So the successful countries are the ones with the largest immigration. Not the ones that defend their borders with, you know, tooth and nail and stop anybody coming in, because again, demographic numbers in the whole of the West and many other developed countries are going down, so they're not enough to support an aging population, and we need somebody else to come in and do the work that we can't do for ourselves anymore. Okay, so unless we can attract foreign workers, you know, the economy is doomed to failure. And we're seeing this, you know, the most blatant example of this is Japan. Japan has got very, very strict immigration rules. They don't want to dilute They won't want to let anybody coming in. It's very difficult to get, a Japanese citizenship. And so they are slowly dying because the population is getting older. Nobody is replacing the outgoing population. So the economy has been struggling for a long time, but this is for fundamental reasons, not because of any short-term decisions. Now, the numbers, the way that the NFP survey is created is through a survey, and a survey that historically has been very optimistic on the numbers reported, and there are various assumptions that are made to come to those figures. Now, regularly there are these numbers are readjusted, and now we are kind of the last published numbers are, for example, for the third quarter of 2023 that we see here. So the numbers, this number here, which is actually a negative number, okay, in the sense that they were, it's not as rosy as the NFP figures would say, and it is about 1 million, exactly 1 million lower than the reported numbers. Okay, so these are the real numbers, and it shows a clear trend in private sector job creation. So you can see that, especially from the first quarter of 2022, the job creation has gone down and down until now. We start this first warning signs, and we have negative job creation for the third quarter of 2003. So, what do you realize? This is like 9 months behind. Okay, so we might not know the real figures that what we're seeing right now for another 6-9 months. And this is why I was talking to you last week and saying that, the Fed can see these figures, can see the up-to-date figures, even if they're not reported. And the same is, with the components of the inflation numbers, they know what is coming, and so they already know. This is why they have talked and basically reassure somebody, everybody, that the interest rates are not going up, because they can see that, their targets are going to be reached with the current in the current situation. So this is another figure that can show you the health of the job creation. So if you see the full-time hiring in private sector companies is actually been negative from 2022. So it's one thing, it says total number of employment may be going up or whatever, but it's, what are these jobs? And a lot of them are, they're very, very part-time jobs, and full-time number of positions has actually gone down. And even here we can see the job creation in cyclical industries that is gone down to very, very low levels, and especially after the peak after the pandemic, it's been steadily going down, and now we are at levels that are below what we saw between 2010 and 2019. Okay, so these things are starting to be felt in the US economy, and you see, like, this is what some of the indicators that the Fed uses. The jobs to jobless ratio. These are the quits rate. So when the quit rate is low, it's low, it's weak, it means that people are not keen to change jobs. So they're not just leaving their job because they know that they're going to get a better paid offer. Now they are actually staying put into their job because they don't think they can find a better position somewhere else. So all these indicators, even the ones that the Fed uses, they are, more positive than the ones that we were looking at just 1 minute ago. They are still, it's difficult to say that the job market is doing well, is trending well. We are now, even the job to jobless ratio is now at levels that were last seen in 2019. Okay, so it's not it's not that successful even by the most optimistic of predictions that they would be using. So this is what is happening now, with all these announcements, the interest rates, the inflation and so forth. It creates a kind of like an expectation that these expectations are traded in the market, in the futures market. So there is a very strong interest rate market in futures, and we can then go and have a look at that and see what the market implied levels are. And these are the latest expectation. So you can see so this is the 5-year interest rate yield future. Okay, so you can see this is the expectation for 1 year from now, and the model point, so the more probable outcome that the market expects is no cuts whatsoever. Okay, about 18%. With the second, just very close by is 1 to 3 cuts. And it makes, so this is when we actually extrapolate the numbers, these are kind of probabilities that are given to different outcomes. So the recession is still seen as a faraway possibility, only about 5% market implied possibility of recession. 13% is that Goldilocks soft landing that the markets have been trying to sell us for a long time, and 82% other expect a sticky landing or a higher for longer scenario. Okay, so these are not, I'm not saying it right or wrong. These are the market implied expectations for what is being priced. Okay, what is the reality? I mean, that we'll have a look at this in the charts in a minute, and we can see that this is what is starting to be more obvious. Okay, so it sounds like very realistic. Now, if we go and have a look in the charts before we go into actually crypto results, and we look at the general, we can look at a few things. Okay, so this is the interest rate yield that you can get by buying 20-year plus bonds in the US. You can see, so what has the market thought about all these latest announcements? Okay, so you can see a drop of interest rates in the past. This is daily. So from the end of May, the interest rate that the market prices in. So you can buy these things now, and they will give you, at the end of April, they would have given you pretty much like 5%. Okay, in the end of May, we're giving you 4.85. And where are we right now? We are at 4.5%. So the market has pretty much discounted 0.5% cut in interest rate during these past couple of months. Okay, so these it's not something that I'm making up. So this is if you go and buy a 20-year bond, whatever this says on the coupon, because one thing is got the coupon that says, what's the interest rate that it pays. The other thing is the price you pay in the market. So the combination of that will give you a yield. And at the moment we just at the moment trading at below 4.5%. Now, and I'll tell you why are these things important. Okay, we can to have a look at it. I'll move from this to the TLT. So this is the ETF that invests in these 20-year plus government bonds. Okay, so you can buy them instead of going and buying the bond itself. You can buy the ETF that's got very low management fees. Okay, so you see what happens. The interest rates, as the interest rates started going up, remember bond prices are inverted related to interest rates. So the higher their interest, the higher the interest rates, the lower the value of the bonds. Because if you have at the moment, if you have, let's say that you bought 25 years ago a 3% bond, At the moment, you can go out in the market and buy something that gives you 4.5%. So why would you want a 3% bond? So the price of that needs to go down to reflect this. And same here. So you see that in 2020, and especially here in 2000, towards the end of 2020, when interest rates started then being raised, you can see that the price, the value of bonds went down from 170 all the way down to 82. Now, if you see something like this, so if this was a stock, and you saw that, would you be tempted to buy it when it's down here? So you see, this is almost like a car crash, like an avalanche that takes the price down by 50%. You wouldn't be tempted to buy it. So who's buying down here? Who's buying down here? So this is kind of institutional level buying that causes an asset, and it's we're looking at this, in this case we're looking at bonds, but it could be anything. And so this is somebody that's got real market clout that manages to move back a market from an extended multi-year trend and move it in the other direction. So this is indication of institutional buying. Now, why do you think institution bought at this price? Because we concentrate always, and this is the problem with many people, concentrate what happens right now without thinking. Institution thinks differently. They are trained to, it's not their own money. They're trained to sit and wait for years. So this level now, the moment the web market has turned around at 82.42. Can we see the last time now that we were at that level? And this, I need to change this chart going from a daily to a weekly because we're going back too far in time. Oops. What's happening down here? So the last time we were at these levels was in 2007. And we are very close. So if we mark here, so this is the all-time low of these products, so 20-year products, ever since it was created. Okay, it was created in 2003, this ETF. Let me just change this color. We'll have this. Okay, this was the point where we saw the market change around, and this is kind of the all-time low. So why are institutions buying at these prices? Because they know that at these prices, that is a cheap asset. It's a very cheap asset. So if we go and figure it out and we look at it, so the last time we were anywhere where the market reacted, and we go back to the daily for that. Sorry, go back to I need to change this slightly lower. Oops. No. So the last time we were at these levels, this is where the market turned around. Okay. And it's not by chance. So this is all the way down from 2007 when we had this basic reversal that took us from 82 all the way to 98. So that's a 20% increase in bonds value. So remember that all the time when you're doing this, you're also receiving a healthy interest rate. So you're getting paid to hold this asset, and it's also going up in value. Okay, so this is the the first time where the price turned around in 2007. So the kind of places where we could have then targeted for a buy order. This is obviously it's aggressive, but nobody's saying that before the reversal happened, nobody could have told you this is where the price will turn around. But definitely, if you could take a little bit more heat and hold these until this level, you are basically making sure that you happy buying at this price because you know that you're buying at the lowest that it's ever been, the lowest that it's ever been. So if you're happy that you're buying at 83, you know, even if it drops like 4 or 5%, it doesn't really matter for you because you know that over time it will gain in price. This is the biggest market in the world, 20-year bonds in the US. So it's and we see why institutions are buying at these prices. So this is the price action that we saw in October of last year, and this is when I started, you know, talking to you about it. You know, talking to you about it when you know, towards the end of the year, when this was obvious, this reversal. So for me, when I look at these things, the point at which I become interested, really, if unless you're following from down here, would be when we got proof that the market is turning around. So we're breaking a level of supply that had been dominant until then. So prices were kept going lower, and this is the first time that actually not, we're not going lower, we're going higher. Okay, so at these levels are about 88, which is, you know, obviously not as good as buying down here at 82. It's still a very good price to you know, to own this asset. And we had, you know, it went all the way up till December, then it came down to 87. So within this range again, which, you know, which is again, it's another buying point here, you know, another buying point here in the market. And now we started moving higher. So this is what the market is doing by its own will, not because of what the government is doing or the interest rate decisions. These are the markets deciding, like people like you and me and institutional hedge funds and everybody else buying these assets. They are very difficult for the government to influence because there are so many of them. Literally, even the US government is not big enough to influence this market excessively. So they can, other markets like the maybe the 10-year notes and more short-term notes, but the 20 years are just too big for them to you know, to manipulate. Now, there's another game I want to play with you. So if we have here, so you know that we are still in an inverted yield scenario. Please mute your microphones. I can get somebody in the background I could hear. Okay, so if we look here on the right-hand side, what you expect in a normal economic condition, you expect the longer-term bonds to have higher interest rates than the short-term ones. Because if you commit your money for a longer term, then you expect a bigger reward than if you only committing it for a few months or for a few years. So there is this measure, you know, they said there have been time in the markets like we are right now, where there's what is called an inverted yield curve. And that means that there's short-term interest rates, like you can see in the 2-year. So generally the calculation is done at 2 years against the 10 years. So you can see the 2 years now is 4.70 and the 10 years is 4.25. So the curve is still inverted. So it's more advantageous to lend money to the government short term than it is a long term. Okay, so why would you buy long term bonds when you can get a better deal by buying short term bonds to the you know, to the tune of half a percentage point between 10 years and 2 years. So we can see this in the chart, and we can see when in the past we had these situations. So if we go US 2-year yield minus US 10 yield. So, okay. Oops, let me go down to a weekly chart. So we can see here, this orange line at 0% line is neutrality. There have been only a few times, and this goes back all the way to 1988, when we had an inverted yield curve. So with this one between 88 and 1990, this one, sorry, Zoom controls always in the way. Let me just move them. This one was the dot-com, you know, boom and crash in the 2000. Okay, so from February to December of 2000, and this was the previous 2008 crash, and this is where we are right now. Okay, so immediately, just by looking at this, you can see that this has gone on for much longer than any time in the past. If we write down here, when did we go into inverted type? So this is like January, December 2088, and we came out of it in June 90. Okay, so write down these things, so you can look them up for yourself. Don't just trust what I'm saying. In this case, we're going from January 2000 to December 2000, so about 1 year. So this one was about a year and a half. And this is in 2008, so we started going inverted here in January 2006, and we moved out of it in June 2007. Okay, so and so this maximum that we've been, it's been shorter than 2 years. Now we have gone inverted in April 2002, and there's still no signs of this ending anytime soon. Okay, so we are 2 years into it already. Now let's go and have a look at these dates in the stock market. So to have a look at this, we'll go and look at the S&P 500. Okay, so this goes all the way down, as you can see, to the beginning of the last century. Okay, so there are figures. There are figures to 1800s as well, though they're not as reliable. The first more reliable figures there from 1928. Now, if we go back then and look at the periods that we were looking at, so the first one was 1988, December 88. So let's go, where are we? Okay, so when we came out of the inversion was in June 2019. Okay, June 1990. June 1990. So this is what happened in 1990. Okay, so a 20% drop from the top of the market to the then to the reversal. It took a while, so we didn't really get above that until February of 2091. So it took about 8 months, 9 months to recoup this drop, and that was the best of the cases, the ones that we looked. So February, the other one was February to December of 2000. So the top of the market was in March. In March 2000, we really started dropping. If we're going to look at this, the more recent drop from September 2000. So let's look at it from here. And this is September 2000 to October 2002. So in 2 years, the market dropped 50%. Okay, so 50% in a 2-year period. And in this case, how long did it take to move back? So this is, in a way, or these things they are showing you it could be described as what happens if you fall more into things. Okay, so this is 2000. How long did it take before, if you bought at this point, which is pretty much a year in 2000, if you bought shares, you bought the market in general at that point, you were not, you didn't recoup your money until 2007. So it took like 7 years to get your money back if you invested in stocks and shares. Okay. The other period was January 2006 to June 2007. So what happened in 2006? And this is quite normal anyway, because if people are, nursing a big loss, what do is that when they can get their money back and they go, I'm out of these things, I don't want to know anything else, I just sell everything and just, at least I haven't lost anything. Okay, so it's a normal reaction. So this is what happened in, I said June 2007, which is here, when we stopped going inverted and we're going back to normal. Anyway, this is the market correction that we have in 2007. 57%. Okay. So 57%, 50%, 20%. Those are the three examples that we had, on the cases where the yield curve has been inverted. So if we can apply from now, because the market seems to be, it looks like, if you look at this graphic, it's the one thing I can tell you is that this is like, a greed and euphoria that is very worse. So we are now right at the top, right, creating basically new all-time highs almost on a daily basis. So what happened if what happened in the past has to repeat itself, even in the best case scenario, so 20% would take us down to, I think it was 20.5%, to take us to about 4,400. So you see now what I was talking to you at the beginning of the year, we're talking about the expectations are at the end of this year that we're going to be between 4,006 and 4,008 in the S&P 500. So this is the best case scenario. We're going to drop, let's say, to 20% from the top. Nobody says that this is the top. The top could be even higher than this. But that's the best case scenario. The second thing, so if we were to drop 50% from here, we go down to 2007. So sorry, to 2,700. So a huge drop, and that will mean that a lot of companies will drop 50, would maybe not suffer as much, maybe just drop 20%, but it will be other companies that will drop 60, 70, 80%. Okay, so that's a big drop scenario. And if we go to the worst possibility, was 57%, it would take us pretty much down to pandemic levels. So things that we've seen in March 2020. So those are the kind of like things that I wanted to show you. But also, what is the worry? If you are FOMO'd in 2000, how long did it take really to make any money out of your investments? Let's say you bought somewhere down here. It took 12 years to show any profits in your, in your account, in your brokerage account. Okay, 12 years. And this is the danger of FOMO into, because as I told you, the same thing with Bitcoin, a lot more people are buying it at high levels than they were buying it when it was at its lows. It's the same for any asset. There is like this FOMO effect. Look, it's going up, it's going up, it's going up. I've got to buy some of that. And that causes you to buy right at the top of the market. So this is like a 12-year gap from 2000 to 2013 to start seeing any positive results in your account. Then obviously from then it's been a success story. So if you look at what are the returns of the stock market over the last 10 years, they've been stellar. We're looking at 15 to 20%, on a yearly basis, which is great. But there are times when there are going to be these deep corrections. Okay, and we might just be approaching one of those times. This is all I'm saying. I don't think we have reached the top of the market by any means, because there will be an extra euphoria the moment that the moment the interest rates are lowered. Is going to be like almost like an amphetamine injection for the markets. So we're going to probably go a lot higher than this, but there is going to be a time when the tide changes. So this is why when we always talk in ARW, we talk about the pyramid, and to structure your investment portfolio properly, because you need to be ready for these events. At the moment, while things are going up, you also you go with the trend until the trend is your friend until the end. So you go with the trend until there are clear signs that the trend is reversing. We haven't seen this yet. Okay, so at the moment is like all sales raised, and we're going ahead at maximum power until the big storm appears at the at the horizon. We're not there yet, but this might be coming. So I don't want to scare you, but I just want you to be prepared for anything that the market might throw at you. Now let's go into some see what happened in crypto during this week. So these are the effects of, I don't like, this is a bit too noisy. Let's go with this and let's remove all these things, let's remove all these drawings. So these are the effects of this all of a sudden, these things that push price quickly in one direction, push price quickly in the other direction. So this is what, how the market reacts to, non-farm payrolls. This was on Friday. All of a sudden, Bitcoin drops from 71 to 66. This was the euphoria, and then we had the other announcement, like we had the CPI, and that pushed the prices up, and so on. So it's impossible to actually understand exactly when certain things are going to happen. But the one thing is that if we zoom out, you can see that we have nothing much has happened since March, since we made this all-time high. The one thing that we can say is that the market is being happy consolidating at these levels, which are the highest Bitcoin has ever been at. Because remember that the previous cycle was 69,000. We're still around that figure right now, and we're now about 67,000. So we're there or thereabouts. Who's been buying at these prices? And that's interesting, interesting thing when you start looking at the whale behavior and people that let me think. Let's see, where did I put? There we are. So the big what is described as a whale wallet, wallets with over 1,000 Bitcoin. Okay, and again, we see these almost like an all-time high. So that means that who's got enough funds to buy 1,000 Bitcoin? So there's like the institutional investors, because you need serious amount of money to buy that many Bitcoins, and the fact that we are reaching a record at the moment, it's indication that there is like an accumulation phase that is going on from institutional level companies like MicroStrategy, like Semi-Scientific, so obviously a lot of these companies have to report as well their investments in when they do their quarterly filings, and we're seeing that how many companies that quote on the stock exchange are bought, for example, the Bitcoin ETF. So this is happening in the background, and also the numbers of Bitcoins on exchanges is at the lowest it's ever been. So those are where the Bitcoins are bought and sold. They need to be on an exchange first to be able to be exchanged freely and easily. Now, what have I got? So other things that I wanted to show you. Let me just first of all look another couple of charts. So this is just the recent price movement in Bitcoin after the interest rate announcements. So this is December, January, March. There wasn't a meeting in February, March, May, and June. Okay. And these are the kind of like price action that we are seeing after each one of these announcements. And again, remember that although Bitcoin is a risk asset, interest rates haven't been lowered during this time, any of these announcements. So we're seeing at 22%, 26%, 20%, 27%. At the moment, if from here, around the 20% move will take us up to about 80,000. So whether it will happen or not, we can only watch and observe the price action, but kind of expectations as well. When you start seeing these patterns that repeat time after time again, is something that you take notice, and maybe you take a position. So this is showing you that since February, the number of Bitcoins on exchanges has steadily gone down. Okay. And while even if the Bitcoin price, as you can see, hasn't really done much. Yeah, it went, from this point, yes, there was a move up in February, but since the all-time high here, the price hasn't really changed that much, but the number of Bitcoin on exchanges has declined to the lowest it's ever been. So again, that shows you that there is like the supply is reducing. Okay, it doesn't show you the demand size on here. It just shows you the price, but the price is a relation between demand and supply. Okay, so if the supply has gone down, it means that there is, the demand hasn't really kicked in yet. There has just been institutional level demand, but we haven't really seen the kind of what we know as the bull cycle, as people forming into Bitcoin, because otherwise this would have been reflected in the price, and the value would have been a lot higher. But this is what, like, the psychological move that the states that we go through in a market cycle. So if you look at that, it almost like you could take this graph and superimpose it on the price action in Bitcoin, and it would describe the previous bull cycle and rebound very well. It would be very similar to this. So so you can see where we are now. Where do you think we are right now in this price cycle? I will say we are in this phase here, okay, between hope and optimism. We haven't really seen this fast grow phase. We haven't seen it. You can see all this between hope and optimism, where things starts bubbling over, starts accumulating, and before there is an explosion. Generally, could happen in either direction, but I still believe that this phase hasn't been tapped at all. Okay, so we are now, obviously, we have gone through the recovery because we are now at the previous peak, and we are now into like an expansion phase that would kind of like lead into the prosperity phase of the market cycle. Now, what was I going to show you? A few other bits of news very quickly. Now, the FIT21, which is again a cryptocurrency. There has been quite a few steps now from the legislators in the US, to start regulating the sector. Now, the important thing is that, like, the US CBDC anti-surveillance state. So whether there's kind of like a really, really strong limits to what can be done with CBDCs, because obviously this is about freedom, and I know that kind of very high on freedom in the US, and the other thing is the Financial Innovation Technology for the 21st century. It's called the FIT21 Act. It was passed by the House of Representatives. It still needs to go through the Senate, to have a chance of becoming law, and then the president could veto if he wanted to. But this is, again, shows you that there is a growing attitude to recognize and legislate this whole asset class, and this can only be a good thing, because the moment that this is not seen as the devil, is seen like a genuine investment opportunity, then the gates will open, because people just consider it on a par with, okay, shall I invest in property? Shall I invest in stocks and shares? Shall I invest in crypto? And it's just going to be an investment decision, rather than being worried what's going to happen to me. Are they going to come knocking on my door if I buy Bitcoin? And there are people that still think like that. So there is also so in different, not just in the US, but also in the UK. There are kind of all these initiatives of creating a framework that can then be can form the base for creating a digital economy, and the country that can work that better than others, can see significant inwards investments, because this whole industry is slowly leaving the US, and it's really starting to find its place in other parts of the world. Now, where is the where are we? Yeah, let me just close some of these. So we can see now that the on-chain activity and corporate adoption, the US lost, as this increases, the US lost 14% of developers' share since 2018. It's now home to just 26% of crypto developers. So now the majority of crypto activity is happening outside of the US. And this is as a clear result of the regulatory measures and the problems that the SEC created for not just for kind of like individual investors, but for companies that are in the crypto sphere, and made it very, very difficult for them to operate in that arena. So as a result, obviously, if you're starting a crypto company, you would not, voluntarily start in the US. You look for somewhere else to do that. And this shows in the numbers. So they're slowly losing, in a way, this innovation race, race to produce these kind of like new products that the whole world is obviously showing voting with their feet and with their wallets that they want this innovation, and it's not going to be the US in providing it. Other things that are kind of like interesting to notice. Now we are seeing, obviously a huge market like India is starting to see crypto exchanges going back and being allowed in. So recently, Binance and KuCoin were authorized to operate in India. They had to pay a fine, but it's like a $2 million for Binance and whatever $41,000 for KuCoin. But that's it's like small fry for cryptocurrencies with a market that's like 1 billion strong, in India. So they'll very, very happily pay that fine to start operating in crypto. So it's again another one. It's like little blocks that need to be in place to get volume in the crypto world, and the crypto exchanges do offer an important they do an important job right now, until we can be in a situation where decentralized exchanges and the decentralized way of dealing with cryptos is good enough to do the same job the centralized exchanges do, and even better. But at the moment they have a very important function a very important job to do. Obviously, another thing that I just wanted very quickly to show you this. These things are going in every day. Okay, so this fantastic new opportunities, fantastic new exchanges. This is kind of like almost like popular mining. I mean, you can, guys, you can't make any money as a single investor by trading, by mining Bitcoin. Just forget about it. And there's not these things that they promise you. Definitely not like that. So when you see these platforms that I think this is another one. I don't know if it was like a trading bot or something else, but the website is still online. Don't really go there, but it's still available. And in this case, it appeared to be an advanced fee fraud. So they kind of like they promise significant amount of money, products or services in exchange for a small upfront payment. And then once you receive this small upfront payment, then they will show you amazing results, and they'll encourage you to deposit more funds and then more funds. So they start with small amounts generally, or $200, $500 only. That's what you need to get these amazing returns. And then obviously people's greed take over and think, well, they're showing me all these results. Why don't I put more money in and so on? So this particular user lost over $165,000. But this is after meeting a stranger online who offered to teach them how to make money trading crypto options. Really? So I'm just saying, be safe in crypto. Better be safe than sorry, because I keep telling everybody, if there was a way of easily making returns of 2, 3, 4% a day, whoever developed such a system definitely would not be sharing it with you. Okay, they would keep it to themselves. They would become richer than Richard Branson, and Bill Gates and Elon Musk put together, and they wouldn't need your money. Okay, so just be very aware of these things going on. The last thing before I stop sharing is now MetaMask has started offering Ethereum staking options as well. So this is a pooling of resources to be able to stake Ethereum, because Ethereum staking, generally you need to lock up 32 Ethereum, which at the moment will cost $112,000 to be an Ethereum staker. And that there have been platforms like Lido and Rocket Pool. They have provided similar functionality. Then now, and Lido is the market leader in Ethereum staking. But for a lot of people, then MetaMask is the easy option, is what they know, what they've been using. So again, it's not a game changer, but it's something that is making life easier to do some of these things. And again, for moving from where we are now to mass adoption, there are lots of these little things that wouldn't be needed to make life easier for people. So I just report to you because it's like filling a puzzle, and you fit one piece at a time. But until you have put a significant proportion of those puzzle pieces together, that you start understanding what the picture is. Okay, so this is, I'm still talking one puzzle piece at a time, and hopefully my hope for you is that you start seeing the picture that it's emerging, and hopefully you do, otherwise you wouldn't be coming back here every week. All right, let me stop sharing. Okay, is there any questions? Not today. So anybody has any questions about either what I have shown or anything else?
Luca, morning. Thanks again. Always very grateful. Just a kind of a general question in terms of when do we foresee some market action from a crypto perspective? I mean, is it only really linked to a lot of the stuff you've shown us this morning in terms of reduction of interest rates and things like that, or is it more around the fact that once the market catches up with the lack of supply, is that what's going to be the trigger? Where's your mind at?
Yeah, it's a cumulative effect. So it's not one thing that can propel the market higher. But the one thing is that to remember that crypto is an asset class. And so if you really zoom out and you look at it, okay, what's that, for you, for your money or for anybody else's money, especially when you're talking about large amounts, you need to make a decision. Where do I put my money? Do I buy bonds? Do I buy stocks and shares? Do I buy gold, commodities? Do I put it in crypto? So there are certain asset classes that do well when in good times. Certain asset classes do well during bad times, like defensive. Crypto is a what is called a risk-on asset. So it's something that needs kind of the good times to perform well. So as what's against especially if you can get interest rates of 5% easily without taking any risk, or without put your capital at risk, that's a very attractive option. As the interest rates start coming down, that option becomes less attractive. The more they come down, the least attractive it is. The reason why the stock market has done so well for many years since the last crisis in 2008, is that interest rates have been pretty much close to zero. So there was very little incentive. If you had any money, you wouldn't be putting it in the bank or buying bonds at 0.5% interest. You would find other ways to make it work better for you. So those are times that propelled risk-on investments. Obviously, if the opposite happened, then there are other things that people would rather put their money in, because they have to have it somewhere. So this is, when precious metals, currencies like more defensive currencies like the Swiss franc or the Japanese yen become, all of a sudden a lot more attractive. At the moment, this is still a risk-on asset. So as conditions become easier for companies and for individuals, like mortgage rates go down, or people have got more money in their pockets, interest rates go down, so companies find it easier to then invest. Those are the times generally that crypto starts moving very strongly. Combined with a reduction of supply, that creates that explosive nature that we see during the bull cycles, that very quickly get prices to increase by 2, 3, 4 times compared to where it's been before. So it's a combination of things, and during each halving, we're seeing that the accumulation that lasts for a period of a few months generally before seeing a strong move to the upside. This is the first time that we've seen a new high being created before the halving. So there are pointers that point to this being a really explosive event as well, but putting a time to it, we can only look at the past. And in the past we've had the move has started happening towards the end of August, beginning of September, and really started moving strongly in October. So those are guesses really, but there is we can only see that the market is getting ready for what is called a breakout. What we don't know is that which direction the breakout is going to happen in first. So, but we can see the concentration, almost like the accumulation of energy into a smaller and smaller price range. And when it moves outside of that, it takes with it a lot of liquidations that generally push the price strongly in the direction of the break. But yeah, just in terms of timing, I would say safe expectations are to say for this to be happening in the fall, but it could be happening any day. Especially if we combine it to interest rate decisions or inflation numbers being released. Those are normally the catalysts for strong moves, as we've seen last week and this week.
Thanks, Luca. And then I have one more question, if I may. Is there should there be any concerns in terms of the last the last bear run, with regards to sort of over leveraged points on exchanges like FTXs and things like that? I mean, do you think the market's kind of dealt with that to a large extent? Are there any sort of red flags that we can look out for that, if you talk about a breakout going the wrong way, that it kind of compounds?
Yeah, but not from the point of view. So what happened with FTX, it was nothing to do with price action. This is with bad governance. So that's all it is. So a company that was badly managed. They thought they used the money as if it was their own money rather than is depositors' money. And there is a lot more oversight now on exchanges. So it is less likely for something like this to happen, at that scale. So it's just like normal price action that we're discussing here. And nothing, I can't see any like FTX style disasters looming on the horizon. Companies that we got Binance. This is by far the biggest company. They've done since 2020. They've done a ton of work on compliance. They are a a lot closer to, to a properly managed bank-like company than they were before. Kraken is going through a pre-IPO phase, so they're going to be probably quoted on the stock market the same as Coinbase. So there's lots of those moves happening to make this more of a legitimate arena. And when we start to see the signs, so most of the Bitcoin miners are quoted on the stock exchange now. Coinbase is quoted on the stock exchange. Kraken is going to be quoted soon. So it's becoming more normal to see companies that operate in the crypto sector to be out there with normal regulation that is applied to any other business. So that it's helping to normalize it in the eyes of people that haven't interacted with it yet.
Thank you, Luca. That's amazing. So we don't need to worry too much about black swan events in the crypto space.
That can always happen, but there is no obvious direction. And obviously, as I said, there is a lot more oversight, so it's more unlikely to see something of that scale happening today. But it's always, they're always private companies, so there are private companies. There is stuff that can go wrong in private companies. So I'm happier when I see these being quoted somewhere and having kind of like a proper market position, because it means that there is a lot more oversight. So we got Coinbase. It has actually grown a lot since since they quoted, and now are the custodian for most of the ETFs, for example. So it's it's a sector that's becoming more mature, put it that way. So I'm a lot more confident during this bull cycle than a little bit of the Wild West that we had last time.
Thank you so much. I appreciate that.
No problem. Okay. Anybody else? No? Okay. If you don't, then I will wish you all a fantastic weekend. I know that I don't think Jonathan is here. I don't see him. I know Anne-Marie is here, so I don't know where you hidden your brother. But Jonathan is not here on the call, but I'll still remind you that he runs a Cardano session each Friday after this call. So I will encourage you to go and follow that as well, because that I give you the high 1,000 meters view of the economy and the crypto market, where Jonathan will give you the specific, the nitty-gritty details of how things are done in blockchain. So it's good to have both views of at the same time. So granular and big understanding of where we stand, and also granular understanding. So I don't have the link myself, but
Luca, I see that one or two people have commented that he's away this week, and I think I remember him saying that last week. I don't know if someone else is running the session.
Anne-Marie wouldn't know. He'll be back next week, I believe. Okay, fine. So not going on this week. So probably not. I mean, I don't know. So if Anne-Marie doesn't know, how would I know?
Okay, thank you.
All right. All right, guys. Whether it does or doesn't, I don't know. If you're on his Discord, channel, then go and have a look in there. It's probably we'll post it in there. Okay, so have a great weekend, everyone, and hopefully we'll have much better price in Bitcoin next week. But in any case, it's still positive outlook that we look at the near future in the next few months. Okay, so I will see you again next Friday, if not in any other event that happening since then. Okay, have a great weekend, everyone.
Thank you very much.
Bye.
Bye.